new series has not been released. And I'm currently looking for information as to who made the decision or what was decided why Microsoft would no longer have weekly options, why it appears to have just have been a one-time series from July 16th to July 23rd. Now for an Excel spreadsheet with the listing of available weekly options, you can just follow this link. We might email this to you all later on in the after the presentation. cboe.com, excuse me, www.cboe.com/micro/weeklies introduction.aspx. That page gives you a brief introduction in the weekly options, but there's a link there that will take you to that Excel spreadsheet, which gives you an updated listing of all the available stocks, ETFs, and indexes with weekly options. Now, as we discussed at the very beginning, your rights and obligations for weekly options are essentially the same. They typically represent 100 shares of the underlying. The exception there is just that the indexes are cash settled. Those four indexes we looked at, you don't per se buy shares of the index and then sell a call against it as a covered call. You would just sell a call, and then if it was trading above that, you'd pay out the cash settlement. Or if you bought a call on the index and the stock moved up, then you do the cash settled requirement to get your profit. They expire at 4 p.m. on Friday. All of the ones on the common stocks and the ETFs, they have the same expiration as the third week option. And the exception, of course, is DJX and SPX, which are the Friday AM settlement weekly options. New weekly options are typically released the Thursday prior to the expiration of the next week, about 8 days prior. So as I mentioned, on July 16th, that new series came out for the expiration on July 23rd. Technically, the weekly options that are out right now were released after the close, right after the market close on Thursday the 22nd. So they're available first thing on Friday the 23rd, and they're going to expire on Friday, July 30th. They can be bought or sold as regular options, turned into spreads, done with leverage positions, for example. Anything you can do with standard options that expire on the third Friday of each month, or with leap options, you can do the same exact things for the weekly options as well. Okay? Now, typical strategies for weekly options, I'm assuming that's why most of us are here. That was just a brief history lesson. Before we go into this, I should mention that I attempted to contact CBOE last week, and what I was looking for was a schedule of upcoming stocks that were going to have weekly options. I'm assuming that potentially 2 weeks from now, as we get closer to August expiration, there's probably going to be another 4 stocks that are released where weekly options are available. I'm assuming as we get closer to September expiration, another 4, potentially another 8 stocks are going to be released. But I could not get a list from them of the schedule moving forward of when the new options are going to be coming out and what stocks they are going to be coming out on. So I'll keep looking for that, and if you follow the blog on Power Options, you'll be able to see updates when and if we know ahead of time what new stocks are going to have weekly options. All right, but when we're talking about the strategies for weekly options, we have to keep in mind one of the standard rules of options investing. When buying options or long strategies, such as trading a long call, a long put, maybe a long straddle or a long strangle, we are buying the options, speculating on an increase or a decrease in the stock price to make a profit, you want to look for further out expiration periods. This allows the underlying security to have more time to move in your desired direction. Now, you do pay more up front, but when you go further out in time, the cost per day is lower. And so, for example, if I look at the August option, at-the-money option right now on Apple, if I compare that to the same strike option 6 months out in time, I'm not going to pay 6 times the cost. It's almost like purchasing insurance. If I pay month by month by month for my insurance policy on my car, well, they might charge me $100 a month, so my total yearly premium would be $1,200. If I request to pay a semi-annual fee, they might only charge me $550 every 6 months, so my actual payment would be lower because I'm paying more up front, so I'd only have to pay $1,100 total for 12 months. And if I paid it all up front, they might give me a discount where I'm only paying $1,000 for the year, so I save $200 on my total insurance policy. Options typically work the same way. About 1 to 2% of the time, there will be a biotech stock potentially or some other stock where news has been released of an FDA approval that's coming out 4 or 5 months down the road. So the near-term options won't be affected, but the options that are 5 or 6 months out might have a higher implied volatility and actually be a higher price per day than the near-term ones. But this is a very small percentage of the time that that happens. With that being said, can you use weekly options for long strategies, for buying strategies, such as the long calls and the straddles? Well, it's not recommended, but it can be done. If I buy a short-term weekly call on Barrick Gold, for example, or Bank of America, I have 7 days for the stock to move in my desired direction to earn a profit. I've really cut my time frame for potential profit very short. Now, the trade-off with that, of course, is that it's going to be a lower cost. We typically won't recommend trading the weekly options for the long calls, long puts, long straddles, where you buy a call and buy a put at the same strike price, long strangles, buying a call and buying a put at different strike prices, or the protective strategies such as married puts and married calls, because you want to give yourself a longer time frame for the stock to move in your desired direction. It gives you a better probability of success when you're long an option and you have a longer time frame. As I mentioned, the problem with buy strategies, well, the actual benefit is when you're looking at the weekly option, naturally your true cost, the time value cost, is going to be much lower because it expires in 5 to 7 days. However, you get that very small time frame for the stock to move in your direction and make a profit, and your annualized cost per day will be much higher. If I'm buying a weekly option every 5 days, if I keep doing that over a 3-month period, I would have probably paid several points more, several dollars more than if I had just bought the same strike 3 months out to begin with. So when we're talking about the strategies that are mostly used for the weekly options, we're talking about the income generating strategies. Covered calls and covered puts, naked puts and naked calls, and the vertical spreads, bull put credits, bear call credit spreads, bull call debits, bear put debits, and even iron condors. Now I have an asterisk next to naked calls because I mentioned at the beginning of the presentation this is one of the strategies I do not trade myself because the risk-reward profile is too high. The risk in these naked calls position is essentially or theoretically unlimited because the stock can go up to infinity, and when you short a call, you want the stock to stay below your call strike price. That call expires worthless in a naked call position, and you keep the premium. However, if I'm looking at a $10 stock and I sold a $12.50 naked call and for whatever reason the stock went up to 100, I'm now on the hook to buy shares of stock at the market price at $100 to sell at $12.50. So, I mean, looking at that, that's a $87.50 loss on a position. You can't afford to do that. Now, is it better to trade, if you're a naked calls trader, is it maybe better to use the weekly options on naked calls as opposed to the standard expiration? Well, it might be, because you have a shorter time frame, there's less time for the stock to move against you. I also don't trade covered puts because I typically don't short stock in my trading account. But these are the preferred strategies, the preferred income generating strategies that most of the clients I talk to who are using the weekly options will trade. The most popular would be the vertical spreads and the iron condors. Some investors are using covered calls, for example, and naked puts, but when the premium's too small, it might not be worth it depending on how many shares you're trading, or I should say how many contracts you're trading, and what your commission fees are. Well, those aren't the only income generating strategies. What about